We're starting here with Juniper Networks, the internet infrastructure company hitting the lowest level since 2013. This after reporting preliminary third-quarter results that missed forecasts. Juniper has been hurt as some telecom carriers delay equipment purchases for the rest of 2014.
Here's an old favorite, number 9, Family Dollar. I haven't talked about them in a little while. Discount retailer at the center of a three-way takeover battle, reporting earnings that missed analyst estimates. This after price cuts narrowed profit margins. CEO Howard Levine says this year was one of the most difficult in this company's history. And I think he's not overstating it.
Okay. Number 8, Alpha Pro, Tech and Lakeland Industries, both of the protective clothing makers, continuing their green streaks today on Ebola news. Since the end of August, Lakeland shares have nearly tripled, while Alpha Pro has more than doubled.
Number 7, Groupon. Evercore cutting the daily deal site to sell from equal weight as part of a new rating system. In the firm's new system, a sell rating forecasts a negative return. Groupon shares are down 45% so far this year.
All right. Number 6, Yelp, the user review site, rated new buy by Sterne Agee. Analysts over there are citing accelerated advertiser growth, good management execution. They also see Yelp as a good acquisition candidate for larger internet companies. So you get a new price target right now of $85 a share.
Number 5 is Tesla, the electric car maker, falling the most in 3 weeks after last night's unveiling of an all-wheel drive Model S. Cool car, not so cool sales prospects, I guess. CEO Elon Musk had created a buzz around the event with a tweet last week. Bank of America says the new updates show Tesla still playing catch-up with its competitors in that SUV space.
Yeah.
Number 4 is Symantec. The biggest maker of security software says it is splitting into 2 companies. The move reverses a decade-old expansion effort. The company says it made the decision after an extensive business review had concluded it needed to be nimbler and more focused. Corey Johnson told us the other day that it was a merger that didn't work in the first place.
Number 3 is Dave & Buster's. The casual dining chain surged on its first day of trading, giving the company a market value of nearly $700 million. From 1997 through 2006, Dave & Buster's operated as a public company until it was acquired by Wellspring Capital Management and HBK Main Street Investors, and so now, of course, they're taking it out.
Number 2, Darden Restaurants. They may not be number 1, but they are the big loser of the day. The owner of Olive Garden lost a more than 9-month battle against Starboard. The activist hedge fund persuaded investors to replace the company's entire board at its shareholder meeting today. All 12 out. Starboard's victory followed a campaign that included an almost 300-page list of recommendations for improvement. You don't get as many breadsticks under Starboard's plan.
Uh-oh. What about salad?
More wine, less breadsticks. I don't know about that. We'll have to go read the plan again.
Number 1 stock of the day, guys. It's Microchip Technology. The chip maker tumbled the most. It's tumbled in almost 14 years after the company said product orders miss forecast. The reason? Well, they're saying falling demand in China. The announcement caused a domino effect. You had shares of its rivals falling as well.